So first of all, I want to thank Standard Bank for inviting us to this year's conference and for taking the difficult decision to give us a session to update you on the Zimbabwean case. Firstly, I would like to say that for the last few years, we used to have meetings within our CCBG, and when you think about our macro economic frameworks and the convergence criteria, Zimbabwe was always left on the side. Why? Because it was a special case. I would like to say this morning that that is no longer the case. How so is what I'm going to try and update you on. Firstly, I would like to talk about very briefly about the growth perspectives. So in 2005, we had estimated that Zimbabwe will grow by 6.6%, but that has been shown to be an underestimate. We are now expecting growth to be 8% plus. This outperforms all of the numbers that you have seen on growth this morning. But the most important thing is the next graph. I hope it's clear enough to give you a summary of the macro achievements to date. Firstly, on annual inflation, which is about 4.1%, and month-on-month for the past 12 to 18 months has been around 0.2%. Month-on-month, in terms of growth of M3, keep your mind on M3 because I'm going to say something about it given our monetary policy framework to date. Of course, we launched the Zimbabwe Gold, the ZiG currency, in April 2004, and we have seen it stabilizing in a band of plus or minus 26%, 26 or so percent, 26 or so Zimbabwe Gold to the US dollar. In terms of total reserves covering the local currency, it's now about 1.2 billion. That's just the local currency, by the way. I will say something about that a little bit later. Our non-performing loans for the banking sector is about 3.07%. Last year, it ticked up a little bit to 3.47%. Foreign currency reserve cover is about 6 times the level of money in circulation, and lending has been maintained at a zero to the treasury. Here, I want to just draw your attention to a few indicators. Basically, I want to draw your attention to the last implied exchange rate. If you look at that, you will find that there is a very consistent slide towards the level at which the ZiG was launched. When we launched the currency, it was about 13.76 to the US dollar. The implied exchange rate is at 14. And you can derive that from the money in circulation and the reserves that we have. Because it's a reserve-backed currency, that's easy to calculate. In terms of the local component of reserve money. Okay, let me now tell you why I keep talking about reserve money. The monetary policy framework that we are on in this period of transition is based on 2 things. We use reserve money as an operational target and the exchange rate as the intermediate target. That's why the anchor, the monetary anchor, will be the exchange rate. So that's why I keep drawing your attention to M3. Now, I think this talks to the month-on-month growth of M3, but I want to stop here where we talk about the amount, the sustained foreign currency surplus that we see in the economy. Foreign currency payment in Zimbabwe have consistently be below the revenues that the economy is generating. And most of those revenues, although we've got a small component of remittances and such, the largest component is from manufacturing. Now, in terms of foreign currency receipts, the resilience of the foreign currency generating capacity of the country is soon a notable increase of about 21.8%. And what you see there is a consistent level of the export proceeds coming through. As you can expect, loan proceeds are very small for Zimbabwe, and therefore we think that at 59.7% of the total foreign currency that's being generated, we're on the right trajectory, because that's actually the economy performing. In terms of other metrics, particularly to do with the breakdown of those foreign currency receipts, gold is topping the list with a share of 45.3%, and platinum at 16.7%. And of course, the agricultural sector, we have tobacco at 16%. I want to draw your attention to ferrochromes. In terms of ferrochrome exports, there has been, in the last few years, a huge investment of about slightly over $1 billion in iron and steel works that produces iron and steel not only for Zimbabwe, but for the region as a whole. Here, we may be taking advantage of Mittal not doing so well, so we hope that things will improve for them. But in the meanwhile, the trends in foreign currency reserves, import cover, indicate that we consistently have not only a trade surplus, but also a current account surplus, with total exports showing a resilient rise and maintained above the imports that we have. In terms of the backing of the currency, as you can see on the green line, we cover about 6 times the ZIG deposits that we have. So as monetary authorities, we are happy. In terms of foreign exchange dynamics, as you can see, it's very consistent, and the premium has consistently been narrowing. Now, in terms of inflation, I think the dynamics talk to themselves. Around June, as I said earlier, we started noticing a big drop in inflationary pressures, and therefore we are now in single-digit inflation at 4.1% year on year. Now, let me quickly talk about a move towards monocurrency, because some in the room might be worried about what it is that will determine when we transition to monocurrency. One of the biggest indicators for us will be whether or not we can sustain the trajectory, and whether or not that trajectory is backed by real assets. We believe that opportunities abound in DPI. We believe that opportunities abound in mining and manufacturing, where we have a huge comparative advantage. But I would like to draw your attention to where money has been flowing. which is in gold, lithium, and in ferrochromes. However, agriculture is showing huge upward movements, and therefore we believe that agriculture, particularly blueberries and tobacco, are doing extremely well. So there are huge investment opportunities in those areas. Let me end by saying what is different. I wanted to begin by saying, if you heard the Ghana presentation, you heard my presentation. So you can see I am talking about something that's slightly different, but if you cast your mind back to Ghana, that's exactly where we are. But talking about the last area that I would like to draw your attention to, tourism. There are huge opportunities and huge incentives for tourism. As you know, the sector that is expanding faster than all other sectors in Zimbabwe right now is tourism. So, and these incentives are across the whole tourism value chain. Lastly, I said what is different. Just quick 4 points, Madam. Let me quickly give you the 4 points that is different this time around. Historically, most of the upheaval in the Zimbabwean economy were centered around money supply. Now, as I said earlier, our currency is now fully backed. So there is nothing that will cause that upward tick. And we will maintain the trajectory as the reserves grow. We have just agreed on a staff monitored program, but I want to indicate that all prior actions and the benchmarks that we have agreed are not onerous, and we have basically met those even before the program began. In terms of how we view the SMP, we view it as being a validation of what we have been doing and what we are doing. Then the third is that the 8% growth has been achieved without this program. Zimbabwe receives very little external financing. And so far, we've managed to sustain all of the metrics that I gave you without that financing. Lastly,
Yes.
There is a close coherence between monetary and fiscal authorities. We hold cash management and liquidity management committees between Treasury and the Reserve Bank every fortnight.
Fantastic.
And there is zero monetization of the government deficit. So thank you very much.